Let's welcome in now Sung Cho. He's co-head of public tech investing at Goldman Sachs Asset Management. Here with us as you see at Post 9. Welcome. It's nice to see you.
Great to see you again.
Man, I mean, Apple down 5%. Just your comments on how this stock is traded. Woodring over Morgan Stanley starts to take his numbers down. I mean, we're talking really well-respected analysts who are taking a look at this now and saying we've got a problem.
Look, I certainly think that we've priced in a lot of negativity, but in terms of what could go right, let's talk a little bit about what could go right with Apple, right?
Please.
So, I think, first of all, I think they do have more pricing flex in their business model, especially in the U.S., where a lot of the carriers have been subsidizing a lot of these pricing increases, right? So we do think they have the ability to be able to price a little bit better than the market anticipates. Secondly, they do have more flexibility in the supply chain, right? And we're going to figure out where is the right place in the supply chain to build, but they do have a lot of supply chain flex that they're going to be able to do. And then on top of it, they do have a lot of balance sheet, power as well, right? And then the last thing I was going to point out is, look, from an AI perspective, there's going to be a lot of innovation coming, right? And every innovation, consumer innovation, is going to have to flow through the App Store. Right, so to the extent that you believe that applications and new applications are going to take off, it has to go through Apple, right? And so there's a lot of things that they can do to adjust. Right now, obviously, the near term is very, very, wildly negative. But there are things that they can do to respond to make this.
The part of the issue too is, notwithstanding the tariff, there was already a belief that they dropped the ball related to AI.
Yeah.
You can't just fix that overnight. I hear you when you talk about the flex they may have with supply chain issues. Wall Street Journal reporting earlier today that they could move some capacity to India. But these things don't happen overnight.
Look, I think it's a very harsh statement to say they've dropped the ball on AI. Look, I think they maybe should have been a little bit quicker to respond to it. But most of what we've seen so far is the build out of the infrastructure of AI. And they clearly don't want to be part of the build out of the infrastructure of AI. But they are going to be there when consumer applications really start to take off.
So it's your largest tech holding, correct?
That is correct.
Along with, a number of these other mega caps, Microsoft and Meta, Nvidia, Amazon, Alphabet.
Yeah.
I mean, those 6 stocks are your largest holdings out of your top 10.
Yeah.
Where are these things going from here?
Look, tech has led the downturn, right? And we've seen a lot of degrossing activity in the tech space. But you have to look at where valuations were and where valuations are now today. So tech has been about a 20% premium to the S&P 500 over a very, very long period of time. At the top, and when the enthusiasm around AI really got going, we were at about a 30% premium. Right now, we're at a 7% premium. So this is the lowest premium that tech has seen in a long time. And if you step back and say, okay, look at the fundamentals around who can actually drive resilient business models in a tariff type environment, it is the tech stocks, right? And you have to think about it as they have more pricing, they have more competitive, moats, so they do have a little bit more pricing power. They do have cleaner balance sheets to be able to invest countercyclically, and they do have higher gross margins, right? And so I do think tech is going to be much more resilient. I think the earnings estimates for broader tech are going to hang in there a little bit more than people expect. And with the valuations being at a discount, we do think it's a good opportunity on a relative
Thinking about,
basis.
as I was writing at this, as you say, a 7% premium, right now. If the economic picture darkens and we rethink earnings numbers more broadly, and we decide that the overall multiple of the market needs to come much lower, then suddenly what is a 7% premium, even if it holds, is lower than it is now. That's one of the problems.
So the market is basically telling you that the earnings estimate revisions in tech are going to be worse than what they see in the rest of the market. And we just don't fundamentally believe that that's going to be the case, right? The starting point around gross margins is much higher. They have more pricing power. They have the balance sheet to be able to flex. And they have durable growth characteristics like AI. And so we do think that the earnings power is going to likely be much more resilient for tech. And so we do think that that's what's creating an opportunity for investors to start reallocating to tech.
Are they recession-proof?
They're not recession-proof. Look, certainly, these businesses are economically cyclical, just as everything else is. But we play in a relative world, right? And I do think right now they have defensive characteristics, but they also have offensive characteristics. Think about that 1 hour where the market whipsawed up. What rallied were a lot of the AI-related names. So there is this pent-up demand to want to own tech. People are degrossing right now, and you can only degross what you own, right? And people own tech. And so we do think that there's a lot of technical forces that are at work as well that are driving some of this correction that's creating an opportunity.
The place where there's been, profound weakness, certainly lately, is the semis.
Yes.
There's also a belief that what was first in, so to speak, is first out.
Yeah.
Some of these have traded a little better lately. Now they're caught up, obviously, in some of the tariff conversation.
Yeah.
How do you see that?
So, look, I think semis have led, tech has led the downturn, semis have led the downturn. I think there's been almost too much negativity now in terms of what's going on with AI and the AI infrastructure build. Right now, we're transitioning from AI models that had very linear types of answers. So you ask GPT a question, and it gives you a very linear response. We're about to go into reasoning models, right? Reasoning models, you ask it a question, it'll remember all the questions that you've asked in the past. It'll also anticipate some of the questions that you're going to be asking. That's the next level of AI that we're about to produce. And we talk about AI agents and all these things. Jensen, more recently, a couple of weeks ago, said that that kind of model is going to require 100x the amount of compute. And so there's obviously more efficiencies coming from Chinese models and things like that. But we do think we're still very much in the middle innings of this build, not in the late innings. And we think that some of the multiples have really retraced to very attractive levels.
I appreciate getting your perspective. Thank you for being here.
Yeah, absolutely.
All right, Sung Cho with GSAM, Goldman Sachs Asset Management.